Building generational wealth is not just about making money. If you want to grow and protect your family in an optimized fashion, you also need to know how to protect your assets and minimize your tax liability. Today, I'm going to break down how you can use LLCs to hide your assets and avoid taxes legally. Without further ado, let's dive in. What is an LLC? As a quick reminder, LLC stands for Limited Liability Company. It is a legal business structure that combines features of both corporations and sole proprietorships or partnerships. LLCs are designed to provide business owners with limited personal liability for business debts and lawsuits without the double taxation burden that C corporations typically face. This means that your personal assets, such as your home, car, and savings, are generally protected if your business runs into legal or financial trouble. One of the most powerful features of an LLC is that it's a pass-through entity. This means that the business itself doesn't pay federal income taxes, and instead, the income passes through to the individual owner's tax returns, where it is taxed at the owner's personal income tax rate. This can generally simplify the tax filing while potentially reducing your overall tax burden, especially for small to medium-sized businesses. I want you guys to understand the T formation chart. Before diving into the multiple types of LLCs that we'll cover, it's essential to understand what I call the T formation chart. This is a simple but powerful framework I use with clients to structure business and personal finances in a way that maximizes protection and minimizes taxes. The T formation chart is made up of three components: a trust. This sits at the base of the T and is essential for estate planning and long-term wealth transfer. Your revocable living trust will be assigned to everything and is a big part of your legacy and continuity planning. Operational entities to the left side. These are the LLCs that run your business and generate active income and pay operational expenses. They often involve daily management, employees, contractors, and customer transactions. And on the right, asset holding entities. These are LLCs that own passive income producing assets like rental properties, equipment, or investment portfolios. They rarely engage in daily operations. Together, these parts create a powerful structure to manage risk, reduce taxes, and build long-term wealth. It is a flexible yet robust setup that helps you grow while staying protected. Now, let's look at the 5 main types of LLCs that you can plug into this structure. LLC type number 1, a holding company for assets. The first type of LLC acts as a holding company for real estate or other passive investments. This LLC doesn't operate as a business. It simply holds assets like a rental property, cryptocurrency, or intellectual property. It is designed for ownership, not activity. But why would you use one of these? Because of liability protection. If someone slips and falls at one of your rental properties, they can sue the LLC, but not you personally. This legal separation protects your home, savings, family, and other personal assets from business-related risks. Holding LLCs also provide privacy. Your name doesn't appear on public property records or contracts, only the LLC's name does. This adds an additional layer of security and reduces unwanted exposure or attention. Let's say you live in Massachusetts and buy a rental in Texas. You'd form an LLC in Texas, not Massachusetts, because that's where the asset is located. The Texas LLC would own the property. It would collect rent, pay expenses, and maintain its own bank account. This also helps to avoid complications with state-specific regulations and taxes. This type of LLC goes on the right side of the T chart. It helps isolate liability, keep financials organized, and protect your growing wealth while giving you clarity and separation between personal and investment finances. LLC type number 2 is operational LLCs for your business or side hustle. The second most common use for an LLC is to run an active business, such as a side hustle or a freelance gig or a full-time venture. These are the income generators, the ones where you're trading time, expertise, or products for money. Let's say you're a realtor in North Carolina. You might form a North Carolina LLC that receives 1099 income from your broker. You pay your business expenses, and you operate under a business name. It has its own bank account. It takes its own tax ID number, which also makes bookkeeping and expense tracking easier. This setup gives you legal protection and professional credibility. Clients are more likely to trust and hire a business that's properly structured and licensed. However, it doesn't automatically save you money on taxes. All profits pass through to your personal return and are subject to self-employment tax 15.3%, federal income tax as well, and state taxes if you're in a state that taxes. That tax hit can be significant, especially as your income grows, which brings us to the next strategy that can dramatically improve your tax efficiency. LLC type number 3, LLC taxed as an S corporation. Once your business starts earning consistent profits, typically over $50,000 net, it may be time to convert your operation to an S corporation by making an IRS election. This is one of the most misunderstood yet powerful tax-saving strategies available to entrepreneurs and small business owners. Let me show you how it works. As an S-Corp, you can split your income into two categories: a reasonable salary, which is subject to the same self-employment taxes of 15.3% a self-employed individual would pay, and a profit distribution, which is not subject to self-employment taxes. This can dramatically reduce your self-employment tax liability. Let's say, for example, your business earns $100,000 in profit and you take a $30,000 salary and you leave $70K for distributions. The $30K is only subject to the 15.3%. Dividing your income like this will result in tax savings worth thousands of dollars. But keep in mind, you must pay yourself a reasonable salary. The IRS watches this closely, and a good rule of thumb is to make your salary right around 30% of your net profit, but this isn't for everybody. At my firm, Tax Alchemy, we normally recommend this as a rule of thumb, but we also have to take into consideration your industry and how much money makes sense to pay you relative to the QBI deduction. If you're a business owner, you'll need to run payroll and file additional tax forms, but the long-term tax savings are often well worth the extra effort. The strategy can be a game changer for entrepreneurs ready to scale. LLC type number 4, management company LLC. This type of LLC is used to provide management services to your other businesses or assets. It acts as an internal service provider, charging fees for administrative work, consulting, or strategic oversight. This approach is more advanced, but it's incredibly effective for experienced investors or business owners managing multiple entities. But why use it? Because it centralizes business functions like bookkeeping, marketing, and scheduling, creating income splitting opportunities for tax planning. It also allows for greater retirement contributions through SEP IRAs or solo 401ks, and it helps with coordinating tax planning across multiple entities or income streams. For example, if you own several rental properties or run multiple businesses, your management LLC could oversee all of them and collect fees from each. These fees are deductible for the paying entity and income from the management company, giving you flexibility in how and where you report income. LLC type number 5, family or multi-member LLCs for legacy and gifting. Finally, wealthy individuals often use family LLCs to hold shared assets like vacation homes, investment accounts, or farmland. These LLCs allow parents to retain control while gradually transferring ownership to children in a tax-efficient manner. Here's why they're so valuable. You can gift membership interest rather than cash or property directly, which may allow for valuation discounts. They allow for centralized control, so you can still manage the investments. They provide asset protection from divorce, lawsuits, and creditors, and they reduce potential estate tax liability by leveraging gifting strategies within the annual lifetime limits. Family LLCs are especially useful for estate planning and asset protection. They also instill shared financial values in the next generation by involving them in the management and governance decisions. In short, family LLCs are a smart way to manage generational wealth and protect family assets for decades to come. They're often used in conjunction with trust and other estate planning tools for maximum impact. Here's my final thoughts. Now you know the top 5 ways the wealthy use LLCs to create privacy and efficiency and to reduce their taxes. Holding company LLCs are to protect and isolate assets. Operational LLCs are to run active businesses or side hustles. LLCs taxed at S corporations are to save thousands of dollars in self-employment taxes. Management companies are to coordinate operations and enhance tax efficiency. Family or multi-member LLCs are to build and protect generational wealth, and the T formation structure brings it all together. With the right planning and strategy, you can minimize taxes, protect your assets, and build a legacy just like the ultra wealthy do. Whether you're just starting out or growing a multi-entity operation, use the right LLC types in the right places to make all the difference. Here's a bonus that I'm going to give you guys as a little bit of a sneak peek into some of the strategies we leverage here at Tax Alchemy. Here it is. We generally recommend that our clients who will be investing in rental real estate set up a parent company. Parent companies have several important purposes. The first is to own all of your holding companies. The second is to hide your identity to give you even more privacy as a real estate investor and business owner. This helps to provide additional protection from lawsuits. And the third purpose of a parent company is to pay your management company. The fourth and last purpose is to file for the net profit and losses of all related parties, aka the holding companies that it owns. And if you're somebody that's like, Karlton, I just want you to build out my entire T formation structure for me, that's exactly what we do here at Tax Alchemy. If you guys are interested in getting entity structuring or leveraging advanced tax planning strategies to reduce your overall tax bill, look no further than Tax Alchemy, the company. Our team is growing, and we have experienced CPAs and enrolled agents that were willing to work with you around the clock to ensure that you save money in real time. My name is Karlton Dennis, and if you like today's video, I want you to do something for me. Like, comment, subscribe, and share it with one other individual that will be growing and scaling their wealth in 2025. I look forward to seeing you on the next video. Cheers.